Good morning. Welcome for day 2 of our conference, The Changing Role of National Oil Companies in International Energy Markets. It's been a very interesting session so far, and judging from the media reports from yesterday's conference, I see how timely we are. On the front page of the business section of the Houston Chronicle this morning, there's a picture of Mr. Malva and Hugo Chavez talking about the relationship between the IOCs and NOCs in Venezuela. So we couldn't be more timely. We have a great lineup this morning, and then more of our research studies into the afternoon. So I'm going to get right started. We are very honored to have a great opening keynote speaker for this morning's session. I can tell you I began my career as a journalist writing about oil in the Middle East, and I won't tell you when I started my career because I don't want you to know how old I am, but when I did, the most innovative and aggressive international player in investments was actually Kuwait, and they really paved a road that many other NOCs have followed and copied. So it's totally appropriate today to have our first opening keynote speaker be Mr. Badr Al-Kashti, who is the chairman and managing director of the Kuwait Foreign Petroleum Exploration Company. He joined KUFPEC in 2001. Before that, he was with the Kuwait Oil Company as an executive assistant to the managing director of operations, responsible for all Kuwaiti oil and field maintenance. That must have been a challenging job over the last few years. And so I welcome Mr. Al-Kashti. Thank you very much.
Well, good morning, ladies and gentlemen. It is my great pleasure to be here and address such a distinguished audience. I'm honored to have this opportunity to discuss with you Kuwait Foreign Petroleum Exploration Company and its catalytic position in Kuwait in helping the local economy despite its relatively small hydrocarbon production. Today, in my speech, I would like to address the theme of this session from a Kuwaiti perspective. This will be done by introducing KUFPEC to you and addressing the areas of interest for KUFPEC worldwide. The KUFPEC story is one of an idea, a rather simple idea that began some 26 years ago. It was also a truly inspired idea. Only today can we look back and fully appreciate that this idea was well ahead of its time. Some 26 years ago, many people opposed this idea. They were skeptical, but this idea was approved, set into motion, and allowed to go forward to either sink or swim. It survived the ebb and flow of time while being buffeted by the stormy areas of uncertainty in the wind of change. But here we are today, and this idea has finally become a reality to create and manage a profitable Kuwaiti international oil company that we all know as KUFPEC. KUFPEC's role 26 years ago was to go international, into the upstream sector, perhaps even to the extreme ultimate production of 500,000 barrels equivalent per day. Once it was launched, KUFPEC needed to grow to a critical size in order to achieve the desired impact on the international upstream industry. The expansion of Kuwaiti production to foreign horizon was a strategy designed to supplement the constraints placed on Kuwait domestic production. By having an international presence, Kuwait could capture a share of the upstream profit that could have otherwise gone to other companies in other countries. Now, what values does KUFPEC actually provide to its shareholders and the state of Kuwait? I believe this can be answered in 4 parts. First, KUFPEC provides a source of a long-term profitability, as well as a vehicle for diversifying income of Kuwait Petroleum Corporation. Example, through KOFPEC, we have access to the international natural gas market. Some of KOFPEC major assets include offshore and onshore exploration leases, oil and gas properties and appraisals and development, as well as oil and gas producing properties. This allows KOFPEC to have a catalytic position in Kuwait, helping the local economy, representing a diversifications, not only the source, but also the quality of hydrocarbon for Kuwait and KPC. Second, KOFPEC provides a mean to access the world-class technology and management practices in the upstream business. We can develop technical skills and foster best industry practices simply by interacting with other international players who are part of our co-venture. Although technology transfer is a long-term process, it continues to be a very important and major area for KOFPEC to focus on in KOFPEC. The third element in here is KOFPEC competitive commercial success. Vindicting the idea 26 years ago has served as the catalyst and the model of emulsion in Kuwait. Inspiring in local Kuwaiti investors in confidence to recently establish their own private E&P companies. In fact, one such Kuwaiti E&P company recently acquired, through a competitive bid process, a share of KOFPEC interest in a producing Seram PSC in Indonesia. Last but not least, KOFPEC is a great tool for establishing synergy between the upstream and downstream business of Kuwait Petroleum Corporation. This important element can be expanded to create a very viable integrated international business unit for KPC internationally. Another part of our story has to do with the strong relationships we have with the states where we operate. KOFPEC has successfully carried the Kuwaiti flag into many host governments, providing not only investment dollars, but also the expertise, knowledge, and of an industry which we are very familiar with. In KOFPEC, we has a several strengths that makes it a competitive company in the oil and gas market industry. It is a subsidiary of a national oil company with unlimited financial resources, clean balance sheets, growth platform in place, strong ties with all governments, where KOFPEC does business and has a small but highly efficient team working to get the company goals and missions accomplished. Our shareholders, KPC, set for us a strategy that we embarked in the year 2001, and it is basically to triple the 2000 production and double our reserve by 2010. Since then, we have managed to double our production and increase our reserve and expanded our work horizon by doubling the countries we work in. We are now in 15 countries. We are in Tunisia, and it is one of the long-standing major producers and contributors to the energy market we are the contributors to the energy market in that country. We are very proud of our relationships and operation in Tunisia. In China, KOFPEC participation in the Yaqing field to create one of the first Pacific gas pipelines and set an example of a trans-state gas sale. In Yemen, KOFPEC participated in the East Shabwa and Jannah blocks, of which combined production account for nearly 1/4 of the total Yemeni production, as well as 3 exploration blocks. In Indonesia, KOFPEC has recently completed its farm-out of Seram PSC to CITIC and GPI, where KOFPEC retained 30% participation interest in the PSC. Our operations there have helped bring economic prosperity, stability to Siram, elements which were urgently needed at the time. During the last few years, we have actively developed new businesses in Pakistan through two major acquisitions. The first one of the Shell assets in joint venture with Premier Oil, and more recently through the acquisitions of BP's shares in Kadirpur gas field. We have had a very long relationship with Pakistan, and we certainly want to continue to grow our relations and businesses. We are in the oil and gas business, but that does not mean we are here to make only oil and gas. We are here to make profit. But we can only make profit by having good people. And by saying good people, because they are the instrument through which goals are accomplished and visions are achieved. And they add color, character, and a class to a company. Just as Kuwait is blessed with abundance of petroleum resources, KOFPEC has been granted the benefit of energetic, talented, creative, and dedicated good people. I believe there is a strength in the cultural diversity of our company. We capitalize on it. It is a relationship that KOFPEC people have created during the course of doing business around the world that have created opportunity to us and ultimately for the state of Kuwait. Our strategy calls for continuous growth. We must grow KOFPEC if we are to achieve our mission and vision. With growth, our ability to access new technologies, new cultures, and new businesses will improve. With growth, we can build our existing relationships with other companies and even new relationships. Let me outline briefly the company's corporate structure, which is divided into a single head office with area offices in Tunisia, Australia, Pakistan, and soon to reopen in Indonesia. KOFPEC is currently present in 15 countries, as I mentioned, with 36 properties. Moreover, since 2000, the company has acquired 27 new exploration projects and 2 production purchases. In addition to discoveries in Australia, Yemen, Pakistan, Egypt, Malaysia, while continually searching for the exploration and development opportunity worldwide. Although we continue to build upon success in focus regions such as Egypt, Yemen, Indonesia, Australia, we are always keeping an eye on new opportunities as well as such as the CIS countries, Kazakhstan, Azerbaijan, Russia. KOFPEC is also seeking relationship with established oil companies that have similar objective and interest as KOFPEC. These potential partners must have demonstrated through past experience their capability to use the latest technology to maximize profit. Further, this must have been achieved without jeopardizing the environmental protections or personal safety, while maintaining their industry position as a leader in developing and operating assets. With this said, KOFPEC is opportunity-driven, as I've mentioned, and of course, the proper partner with the good opportunity will always attract our attention. This is not to say that these opportunities, which are similar in some respects to other large, financially attractive projects around the world, are not without challenge. Each of these investment opportunities offer a unique set of rewards and risks. The challenge is to properly address the unique risk associated with each opportunity in an efficient and effective manner that will generate an attractive investment opportunity for the shareholder of the company. In our case, is KPC. So let us return to the beginning of our beginning. Our company began as a simple idea some 26 years ago, ahead of its time, But though hard work and perseverance, we have become a reality, and a successful one, I may add. So far, I have, as promised, spoken of KOFPEC's role as an NOC from the Kuwaiti perspective, addressing how KOFPEC upstream activities benefits Kuwait and KOFPEC shareholders. However, it is worth noting that KOFPEC, together with the upstream NOCs, plays another very significant long-term role in today's world. NOCs represent their nations as unofficial ambassadors of energy when interacting with other NOCs and states, and the alliance and partnerships we forge, the common grounds and mutual interests we explore and help distribute over the globe the moderating and stabilizing effects of commerce. Simply put, pockets of the world have always quarreled over politics and religion, but commerce and shared economical interest work to link and strengthen ties of mutual interest that supports productive, progressive, and peaceful relations. Nations linked by pipelines and shipping lanes are more inclined to amicably resolve their differences. Arab has known this truth at least as far back as the days of the silk and spice caravan, which traversed continents to link economic of nations across the world. In addition, the presence of KOFPEC and other NOCs, particularly in underdeveloped countries and countries recovering from natural disasters or political turmoil, typically bring infusion of capital, opportunities for local employment, and social contributions, such as constructing roads, schools, and hospitals. That makes a positive impact on the economics of such countries and lives of their citizens. So while it is undisputed that KOFPEC is a commercial venture working to bring a profit to shareholder, those who take a large view will observe that our upstream activities are playing a direct role in working towards world peace. In closing, let me say that I hope that we'll see more oil and gas opportunities worldwide that will allow all of the oil and gas companies to work together on these mutually beneficial projects that will have a role in helping the world secure its growing requirements of energy supplies. And I for sure know that we KOFPEC are determined to have a significant role to play in exploring and developing oil and gas resources, providing energy to the world by helping of our mother company, KPC. Ladies and gentlemen, my honored guests, thank you for the attention, and I hope that you enjoyed the conference. Thank you.
Nobody's finished their coffee yet? Okay, you get off easy.
Okay, that's good. Thanks.
Okay, our next keynote speaker is Claire Lowry. Claire Lowry is with Accenture. Hold on, I was too fast without opening the page. She's a senior manager at Accenture. Her specialty expertise is in strategic planning, country-facing strategies, NOC relations, upstream business performance, diagnosis and transformation, and organizational change. She co-authored the recent Accenture study, The National Oil Company, Transforming the Competitive Landscape for Global Energy, and she'll be presenting that study here this morning. Thank you, and welcoming Claire Lowry.
Ladies and gentlemen, good morning. I'm Claire Laurie, and on behalf of Accenture, I'm delighted to be here to share our perspectives on how international oil companies, IOCs, can respond to the increasing global reach and the competition from national oil companies. 1 year ago, Accenture presented the results of its own NOC study at CERA Week here in Houston. In our conversations with various clients globally, it was really clear to us that NOCs and IOCs have very different perceptions about one another. Accenture works for governments, for energy ministries, for many NOCs and IOCs, and from the conversations we were having with them, the perceptions were very, very different. And this is essentially what led us to undertake a study on IOC and NOC relationships. There was a particular disconnect in terms of how IOCs, how they thought they were doing in accessing reserves and building relationships with NOCs, and how they were actually doing. In our study, we wanted to understand the ingredients of good partnerships between IOCs and NOCs. So we simply asked the NOC executives what they thought. We carried out interviews with 13 NOCs and we profiled 20. We selected NOCs which were resource-rich, those which were resource-poor. We interviewed NOCs in all geographic regions. We included purely domestically focused players and also international players. We covered those as well which had strong links with their governments and those which were a bit more autonomous from their governments. So what I'd like to say here today is share with you some of the findings from our study. Plus, I'd also like to share with you some of the experiences I've had personally in working with energy ministers, NOCs and IOCs in places like Angola, Caspian, Trinidad and North Africa. But let me provide you with some context to begin with in terms of changing energy dynamics. 10 years ago, the energy industry was rapidly opening up. IOCs were thinking about merging. They wanted to be able to better compete in the global upstream market. Today, with many of the mergers undertaken, the competition for upstream assets seems to even still be even more intense. Plus, the competition for people and supplies have also intensified. One reason for this continuing rise is energy demand. By 2030, global oil demand is expected to reach 120 million barrels per day. And in the past, this demand has been met by more traditional areas such as the Gulf of Mexico and the North Sea in the UK. All of these areas are becoming more mature. International oil companies are looking for reserves in frontier markets. Access to these new reserves is, of course, primarily controlled by the national oil companies or their resource-holding governments. 9 out of the top 10 reserve holders are indeed NOCs. Now, these NOCs are different to what they were a decade ago. NOCs are competing more internationally, they're more confident, they're asset-hungry, and they're more outward-looking. NOCs have higher expectations in their domestic markets at home. Most are concerned about the development of their economies as well as their commercial goals. We also see the return of resource nationalism in places such as Venezuela and in Russia, of course, and almost all are cash-rich. So we're in a situation where the competitive landscape has very much changed. However, with high and sustained energy demand, the good news is that IOCs and NOCs need each other and have to work together to serve and meet that demand. So this really sets the scene for IOCs and NOCs having to work together, even though some of the playing cards have changed. Now, much has been said about the increasing power and the maturity of the NOCs. We have seen in particular the Chinese and the Indian companies becoming more international and more aggressive in their bids for resources. We're also seeing a number of NOC consortia, and they increasingly prefer to make deals with each other, so NOC deals with other NOCs, often leveraging government-to-government relations to do so. Now, there are several factors that are positioning NOCs to compete for assets much more competitively than before. Firstly, they've raised the game on their technical capabilities. This is reducing the reliance on IOCs and their technical expertise. In fact, over the last decade, many IOCs have underinvested in their technical capability, and now they're trying to catch up again. And NOCs are showing greater confidence in contracting with oil services companies such as Halliburton and Bechtel, who have been investing in their technical capabilities. So companies such as Petrobras and Statoil are moving into international arenas using technical expertise in places like Deepwater Gulf of Mexico. Secondly, they are moving out of their domestic borders into the international arena. The number and the value of deals NOCs are undertaking has been increasing year on year since 2000. In 2005 alone, NOC merger and acquisition deal activity reached a value of $33 billion. And in 5 years prior to that, it was $0.1 billion. So 0.1 to 33 billion. Chinese and Indian NOCs are increasingly looking for opportunities in resource-rich nations, such as West Africa and the Caspian. CNOC and CNPC, for example, already derive 1/3 of their revenues from overseas assets. Even the internationally shy Algerian Sonatrach announced last year that by 2015 it wanted 30% of its revenue to come from overseas activities. National oil companies have also become very successful in making deals globally because they're willing to invest in the downstream in order to access the upstream. A good example of this was the Nigerian licensing rounds in 2005. Here, Asian companies bid for key blocks against the IOCs. These companies agreed to invest in Nigeria's refining business and also infrastructure. And in return, they expected and they received preferential treatment in the award of E&P blocks. With the sustained high oil price, any doubt about the ability of NOCs to finance their own deals is diminishing. Many NOCs are semi-privatised, listed on key stock exchanges, and adhere to the same or similar financial controls as IOCs. As a result, they are combining good financial management and the abilities to increasingly self-fund their own operations. Added to this, of course, they have the ability to rely on, in certain cases, government for financing. When CNOC was making its bid for Unocal, it was making its offer in cash, $3 billion of it from its own balance sheet. Such funding is very hard for an IOC to match. Finally, many NOCs even have strengthened their governance and their independent decision-making. NOCs like Aramco and Statoil are structured so that their company operations are kept separate from the ministry. So where does this leave the IOCs? It sees them coming face-to-face with the NOCs more often, not only as customers, partners, or custodians of host country resources, but as very strong commercial competitors. Technology and capital are no longer sustainable differentiators that will help IOCs differentiate themselves. So what can IOCs do? Accenture believes that one of the most fundamental steps for IOCs is to truly invest the money and the time in understanding NOCs and their priorities better. We cannot group all NOCs together. They're all different and should be handled as such. They have different objectives, they have different governance, they have different structures, they have different styles. In the interviews that we did in our study, security of supply and revenue growth did not even rank in the top 2 priorities for all of NOCs. Many of the resource-poor NOCs are focused on meeting high demand in their domestic markets and opening up the downstream. They're hungry for suitable assets abroad in return for downstream access at home. Other NOCs are focused on very specific priorities, such as developing gas marketing, deep water skills, LNG project skills. Another key finding from the study is that the NOCs are tending to adopt a very, what we call, project-based mindset when dealing with IOCs. What this means is that the IOC relationships, they see the IOC relationships in terms of being just requirements for their particular capital project. This means that IOCs' dealings with NOCs are becoming increasingly transactional. However, the NOCs are increasingly open to new deal structures rather than project-by-project, asset-by-asset transactional deals. But for the IOC who's looking for a long-term relationship with an NOC, this transactional approach can be hard to manage. Finally, NOCs also, many of them told us that they want to play across the value chain. There's evidence that they're interested in becoming more fully integrated with international oil companies. Many NOCs are translating their need for supply security into a hunt for those assets that can drive future growth and capabilities for the companies across the entire value chain from EP right down to downstream. Based on these findings, one clear priority stands out in terms of dealing with NOCs. That is, to be successful in this new world, where access to opportunities is becoming more limited, IOCs need to differentiate themselves. And how can they do this? Well, we believe that there's a variety of ways to do this. The first is understand the NOC's priorities. You develop an NOC strategy, just like you would with any market entry or a customer strategy. They need to think of NOCs in terms as a mindset, as a client. This is about more having a marketing or a service provider type mindset rather than an engineering one. Without such an approach, they will overlook the unique NOC priorities and run the risk of losing the deal or commoditizing themselves. The outcome of this approach will be a strategy which is tailored much more tightly and focused on the specific NOC. And what should this deal or what should this offer look like from an IOC? Well, it should be able to create value, meet the compliance needs of the company, and of course be differentiating. At its heart, it should be set up as a win-win situation, clearly for the IOC and the NOC. In securing partnerships, IOCs need to be flexible and be prepared to be much more creative in their deal-making. Making an offer based on just commercial and technical credentials alone is no longer differentiating. As some companies are off calculating the NPVs of a particular project, other very successful companies are securing deals in other ways. Some have secured deals that link the investments with the upstream and the downstream. They may not want to invest into the downstream, but will invest in the downstream, calculate the economics around it in order to access the upstream. Others are linking assets across multiple geographies and also across product ranges. For example, in Libya, the energy ministers expressed desire for more downstream investment in order to grant IOCs upstream opportunities. The signing of the Marsa El Brega integrated LNG project between Shell and the Libyan NOC in 2006 is a good example of this. NOCs also like creative deals which offer them long-term value. Asset swaps were mentioned frequently in our interviews. NOC see this as a way to build the portfolios they want. There's a strategic aspect to the swap that can be value creating, i.e. it enables the NOC to develop a skill or enter a market which is way beyond the standalone value of the asset itself in discussion. The asset swap between Shell and Gazprom back in 2005 is a good example of this. The opportunity to acquire assets that are not on the market and will never be traded openly is absolutely essential to any company strategy. IOCs should see the deals they are making as part of forming a long-term strategic relationship, a marriage with the NOC. The deal should aim to broaden local content for that nation. Such approaches are being very successful in IOCs in countries like Angola. In Angola, the majority of the population live on less than $2 a day. IOCs in response are focusing to building the supply chain to increase competitiveness of the Angolan oil sector. This in turn increases in-country spend, which creates jobs and which creates services. Economic development of the nation is always a key consideration of any NOC, and in this case Sonangol in Angola. In short, IOCs are linking company success with country success, and those which do that are being much more successful with the NOC relationship and therefore much more successful in winning deals. Increased local sourcing is one way of reducing costs for IOCs. Importing from abroad obviously costs with a premium, but also at the same time creates economic wealth for the country. IOCs can often spend more in their supply chain on supplies, way more in supply chain than they would pay in government tax revenue. So in-country sourcing for IOCs can reduce costs for them and also make a very material impact in a particular country. There are local supplier development programs in Azerbaijan that's had the impact of channeling more dollars in the country and at the same time reducing procurement costs for a major IOC by 15% in the first year alone. And of course, at the same time, that particular IOC has jointly formed a steering committee with the national oil company SOCAR in Azerbaijan. Very much a win-win situation. When I worked in Trinidad, the government and the NOCs and the IOCs formed a joint team together to develop a strategy for the nation to progress economically, environmentally, and socially. Now, for me, this was really clearly about teaming and using business acumen to solve social issues. For example, the IOCs who would normally compete with one another to build large offshore gas platforms and fabrication yards, they actually collaborated together, aggregated their demand, and then pushed that into local fabrication yards in Trinidad to help them build out and finance the country infrastructure. And this was with the government working with them together. There were some IOCs that didn't partake in this, and they're losing out a result in many of the EP licenses. Finally, NOCs which value those IOCs, the key things that NOCs value are basic operational management and delivering cutting-edge technology. In many projects today, the basis of competition is around operational excellence and certainty, simply delivering the basics of the business more efficiently and more effectively. A number of high-profile overruns over the last year have tarnished many of IOC's track records in this. IOCs must hold on to their reputation and ability in operational excellence. Just a month ago, ExxonMobil announced the cancellation of a multi-billion GTL project in Qatar, citing costs as the reason. What was significant, however, was that in its statement, ExxonMobil said that the project was not consistent with its investment approach, which aims to maximise both value to shareholders but also to the host government. If projects are not set up in a win-win format, IOCs must be prepared to walk away. The emerging competitive landscape, which will now see IOCs facing NOCs on two fronts. One, in open international markets, where NOCs now present both a potential venture partner or a commercial competitor. Two, in major resource-holding nations, where not only is there a host NOC, but now other NOCs are regularly competing for those assets in the host nation. To collaborate with the NOC as a partner and to bid against them as a competitor requires a clear understanding of their priorities and developing a longer-term relationship. NOCs continue to value the basics: IOC's project management, integration and gas industry capabilities. They often encourage the presence of IOCs in their markets, which can send a signal to the world that their country is opening up, such as the case has been in Libya. High oil prices are increasingly empowering rich resource nations to extract more value for their future. If IOCs want to be part of that future, they need to start talking a different language, which includes words like client, collaboration, oil funds, social responsibility, and economic development. The world is a very different place in 2007. Finally, to steal a line from another speech that you just might know, ask not what the NOC can do for you, but what you can do for the NOC. Thank you.
Do we have any questions for Claire? We are not a question-answering group this morning. No thoughts or comments? Okay. Yeah, go ahead.
Related to the LNG, recently, as we all know, Iran and Russia have been thinking about forming an OPEC-type LNG consortium. What's your comment on that one? What do you think the future impact would be on the energy contract that are already being sold?
I think as a general trend, you're seeing NOCs and NOC or country-in-country government starting to set up consortia like that one. So it could be memorandums of understandings or OPEC similar type deals. In any case, as soon as you build consortia like that and increase the monopoly of the market, then prices are going to go up or supply is going to become constrained. So the LNG market, which is becoming increasingly global, increasingly popular and as part of production growth targets for IOCs, any monopoly, whether it's Iran or Russia or anyone else, makes supply tighter and pushes prices up.
Claire, you talked about the nature of the NOCs as being quite variable, but do you see them staying as variable as they are, or do you see them separating more or less into two camps, the ones who are able to do things more or less to international standards and the ones who will be heavily reliant on IOCs to do their work, or do you see the same sort of distribution that we have today?
I think they'll all continue to change, but I think fundamentally they're either resource rich or they're resource poor. So in the Chinese, they have huge domestic demand that they have to fill. So they hungrily run to the Caspian, run to Africa to feed that domestic base. Other NOCs which are very resource rich, the Saudi Aramcos, they don't have such pressure to go out and compete internationally. So I think they're all very different. Some are very small, domestically focused. Some are very, Petronas is very international. Statoil is almost like it's like an IOC itself. But fundamentally, it comes down to whether they're resource rich or resource poor, because that will drive the fundamental economics of whether they have to compete and bring assets back, or whether they have to help develop the domestic economy. So there's still those two groups, but they're all still individually quite different. But one of the trends I see overall is that many of them have international aspirations. So not many NOCs, or the N in NOC, national, is actually probably should be international, because many of them are pushing that direction.
Do you see IOCs becoming increasingly involved in economic and social development in the NOC countries beyond industry-focused, say, local content, training, and that type of thing? Do you see them taking on a broader role?
Absolutely, yes. When we look at this, traditionally, many IOCs have seen their contribution to social and environmental concerns as being some public relations, some good philanthropy in schools and PCs and other such matters, in the ones of dollars of impact. Many of the IOCs, and this was, a department such as external affairs or public relations, but actually a lot of IOCs have completely clicked that they can actually contribute to economic development in a way which is very much part of their core business. Every IOC needs sourcing. They need sourcing of people, and they need sourcing of supplies. They have a choice of how much of that moves in country. When they start moving in-country salaries to local people and in-country supplies to people, they are effectively, this is part of their core business, but they are making a huge material impact on jobs and on services. And, some of it is related directly to the oil sector. It could be front-end engineering, it could be fabrication yards. But they're also investing in people who in project management skills or finance skills. Now, if you're a finance person for an oil company, you can be also for an insurance company. So you see that when they start investing in one sector, by the very nature of the oil industry, it helps other sectors grow as well. Professional services, administration services, and then also in manufacturing. So many companies have understood that by making that type of contribution there, that they are impacting the country. Now, some of the interesting things in terms of how IOCs move forward, and sometimes they actually make policy advice to the government. So, for example, if you look at tax revenue, where it's hundreds of millions of dollars of impact, some IOCs have convinced countries, like, for example, in Norway and Azerbaijan and increasing Angola, to set up oil funds, which ring fences the tax revenue money so that the current revenue can actually start helping the future generations, as well as balance some inflationary pressures. So I definitely see a move from IOCs giving charity and philanthropy, community type initiatives, to much more hard economic, and it having a very good multiplier effect in flourishing that economy.
Okay, well, thank you very much.
Thank you.
Okay, our final keynote for this morning has a very interesting topic, which is to look at how capital markets view the NOCs. I'm happy to introduce Tom Langford. He is the managing director and co-head of the Global Energy Group for Morgan Stanley. Mr. Langford is responsible for major integrated and selected independent E&P and R&M companies. He's also the head of the Houston office here for Morgan Stanley. He has had a long and illustrious career both at Morgan Stanley and previously at Exxon and McKinsey. And if you look at the list of mergers that he has worked on and advisory services that he has done, it includes the privatization of PTT in Thailand, of Sinopec of China, and the Gas Authority of India. Let me welcome Mr. Tom Langford.
Terrific. Thank you for that kind introduction. Let me just take a moment and thank the Baker Institute for allowing us to participate in this gathering. We're delighted to be able to play a role, and we're particularly delighted with the opportunity to come and share some views with you today. The topic of my discussion is how the capital markets view national oil companies. I think as we heard through the course of the day yesterday, there are a lot of differences among the various NOCs in terms of both strategies and behaviors. During my brief comments this morning, I'm going to plan to lump together a number of these publicly traded NOCs, really for the purposes of making some analytical observations, but I would assert that the same statements largely apply to the non-public NOCs as well. I think various speakers have discussed some of the structural changes occurring in the energy industry. And if you take the perspective of an international oil company, whether it's falling reserve replacement, increasing cost, flat, or in some cases declining volumes, all are symptoms of one underlying cause. And that cause is that energy is migrating to emerging markets, and therefore the resource holders, the NOCs, progressively have the advantage. The equity markets have been quick to recognize this, and there's been a migration of value to the emerging markets over the last 4 years. But there's also a more interesting suggestion that the winners of the last century may not be the winners of the 21st century. I think to be a bit more provocative, if the supermajors were the winners of the past, I think it's a viable question to ask, which is, will they still be the winners going forward? Or put another way, is the supermajor a 20th century concept? I'll start with 4 observations that begin to suggest that things have changed. This chart, apologies for the scale, says something pretty important about how the markets have viewed and valued international oil companies. This chart plots, since December of 2004, the share price performance of the different subsectors of the energy industry. Specifically on this page, you see international oil companies, mid-cap integrateds, European and U.S. service companies, European and U.S. refiners, as well as national oil companies. The IOCs are the green line at the bottom, and as you can see, overall share price appreciation has been in the range of 30% versus the national oil companies, the purple line, at around 150%. The markets have become much more concerned about absolute performance than relative performance, and investment has become more global rather than regional. As a result, investors are looking for absolute performance from a much broader range of companies. Furthermore, although investors have always had a choice in their portfolios, the sheer dominance of the market cap of the 5 largest supermajors meant that they were the critical decisions. Today, with 14 companies in the global energy with a market cap of over $50 billion, there are not only a large number of companies, both IOC and NOC, to choose from, but any large-scale portfolio manager has real choices as to where to invest his money. The point is that the IOCs are not the superstars they once were. They've fallen from their perch. That's a challenge, and this next chart shows really a similar message. Here we plot from 2000 through projected 2008 the price-to-earnings multiple of the IOCs versus the mid-cap integrateds, E&P companies, and NOCs. The point is the IOCs, which is the green line, used to enjoy a big premium multiple. You'll all remember the dawning of the era of the supermajor with the promise of inherent scale, technological capability, capital, and that these companies were meant to be the clear partner of choice for the national oil companies. All this was meant to lead to a sustainable valuation advantage. Well, as you can see from this page, the premium valuation enjoyed by these companies in the early 2000s is no more. Everything has leveled off. But more importantly, look what happened to the NOCs. That's the purple line. If anything, they now trade at a slight premium to the IOCs. That's a big change. It's something different. Now here's a third change I want to call to your attention. This chart's a little complicated to read, but what it shows is that the capital markets' attitude to the emerging markets generally. Here we track in the green line the performance of emerging market equities relative to an index of world equity market performance. And in the red line, against the reverse scale on the right-hand side, the spread of emerging market bonds, which has steadily tightened since 2003. The point is, investors, the world capital markets are now much more comfortable than they have been with emerging market investment risk. Said another way, risk has been re-rated across markets. This re-rating of risk has substantially added to the momentum of not just emerging market stocks, but to higher risk stocks within developed markets. Or putting it in another way, the premium for blue chip has basically been eroded away. Obviously, trees don't grow to the sky, and emerging market risk will no doubt weigh back into the market. But in the meantime, the re-rating of risk has a positive effect on national oil company valuation and reduces the cost of capital in funding their growth opportunities. Let's put these first three observations together in the next slide and see what this means for the energy universe. This chart shows in two ways the composition of the market capitalization of the energy industry. On the left, we show in absolute numbers the market capitalization represented by each of these subsectors. The bars are rising as values have gone up. But note in particular the rate at which the NOCs, the green bars, have risen since 2001 relative to the much slower rate of increase of the IOCs, which are the red bars. Highlighted on the left, where the same numbers are shown in percentage terms, again, the contribution of national oil companies has changed dramatically from representing around 13% of total energy market capitalization in 2001 to 38% in 2006. While at the same time, the IOCs have shrunk from a dominant 70% to around 40% today. So something's changed in the market, that's for sure. Now, let's talk a minute about the industry realities against which this is happening. First is cost, and I think everybody knows what the message is on these charts. But costs, as represented by finding and development costs, have risen considerably since the 90s. Furthermore, I don't know of any oil companies that see F&D costs declining from their current levels. And complexity and size of the projects that the industry is taking on is on the increase. We've heard a lot about non-conventional projects, including oil sands, LNG, GTL, heavy oil, very deep water. These are among the most expensive projects undertaken by oil companies. Just using the projects we know about, these moved from representing 14% of production in 2003 to roughly 22% of production in 2010. Also, given the sheer scale of infrastructure associated with many of these projects, there's an increase in the level of single project risk within IOC companies and portfolios. Eni with its Kashagan project or Shell with Sakhalin are probably the best examples of this types of concentration. But of course, the real story is the resource base. Here are the familiar charts about reserve replacement on the right, and the idea that old, mature basins have been worked and reworked, and that returns are diminishing. Access to resources is now the single most important issue for IOCs. Although declining throughout the period shown, reserve replacement was in fact relatively healthy until only a few years ago. However, this masks the longer-term trend for oil companies. The healthy reserve replacement that we saw before the decline set in was largely a function of upward revision of the existing assets. That's the other side of the page. It was not the result of access to new areas. The oil companies are not getting worse at finding new oil and gas. The current difficulty in assessing genuinely new resources has existed for some time. It is simply that the oil companies managed to overcome or delay this difficulty using technology or better field and cost management to extend the reserves of the fields that they already discovered. These are the challenges that are being faced by the IOCs. The 21st century is clearly not going to be like the 20th century. As we start thinking about who the winners will be, we need to look quickly at some 21st century realities. First, where's the growth going to come from? We've talked a lot about that through the course of the last day. Whereas before, in the last period, and we've shown this from 1975 to 2000, the other category constituted the bulk of the production growth. Within the other category, the single largest contributing area to world production growth was, in fact, Western Europe, with the discovery and development of the North Sea in particular. Even during this period, the IOCs had less access to resources, as the majority of the resource-holding nations excluded them from their production. However, they had an adequate alternative opportunity set and developed substantial OECD asset bases, which are still generating the bulk of their earnings and paying their dividends today. Now, going forward, according to the IEA, OPEC and the former Soviet Union will dominate as a source of future production growth, and unfortunately, it is precisely in these areas that the IOCs have had the greatest difficulty accessing resources. And here's another thing that we all know and have talked about. The resource base is in the hands of OPEC, and in particular, the big 5 OPEC countries, which leads us all to being very much aware of the emergence of national oil companies in general. As we have heard from other speakers, these national oil companies are not just developing their own country resources, but many of them are actively competing on the world stage for additional resources, all of which is leading to a much higher level of competitive pressure. There is no question these NOCs are capable of operating in the international arena, and there is clearly still a role for IOCs, but they must compete with an ever more sophisticated group of NOC competitors, some of them with the explicit support of their governments. And here they are, many of which have been the focus of the Baker Institute studies. But it is very clear, any way you look at it, that the NOCs dominate, whether it's through the resource or through the downstream markets. And the capital markets themselves recognize that many of these NOCs have the resource base for sustainable growth, attractive cost structures, technological sophistication, and scale. But this isn't another way of getting at the question of resource nationalism. My point is slightly different. It suggests that from these companies, despite the politics and issues of sovereignty surrounding them, there may be a few that emerge as recognizable to the markets as super NOCs, the replacement for the super majors as the oil company of the future. I want to finish by going through some criteria that I think will define this market-friendly NOC. But first, let me spend a minute on why this hasn't happened yet. What's interesting to me is, with all the NOCs that now have public shareholders, why hasn't this happened yet? Interestingly, I think in our experience, this is partly a mindset issue, even to the point of saying there's a tendency, in many cases, for some of the more advanced public NOCs to almost apologize for not being private in their interactions with investors. I think another reason is that the investor community still doesn't really recognize the category yet, but also there's a lack of awareness of what's needed. What you see in this chart is a list of other causes, which could include, and do include, commerciality, concern with access to capital, government bureaucracy, inwardly focused cultures, lack of initiatives, and I'm sure there are many other plausible reasons. But we believe that's changing, and companies are now having to face the market and will be forced to face the market, which leads to the question of what will be the criteria for the super NOC. Here I think it's anybody's guess, but I've put together a few suggestions on the slide, and those are things like preferred access and government sponsorship, which we think is a positive, ability to align corporate, investor, and national objectives, commercial focus and commitment to bottom line, capital efficiency, access to technology, balance of growth and returns, motivated and efficient management, many of which have been discussed today in much greater detail, much greater specificity by other speakers. But I think broadly, it's going to be really about acting as the interface between the majority shareholder and the rest of the stakeholders. Now, this hadn't happened yet, but we believe it's coming, and I think when it does, we'll all recognize that the oil company of the future has arrived. Thank you.
Okay, well, hold on a second. Thank you for a very interesting and provocative view of what the super oil company might look like in the future. We have any questions from the audience?
I'd like to say thanks for a very interesting presentation. I didn't see on your slide of how the share prices have changed over a period in favor of the national oil companies, how the Western oil services companies had performed in relation, and whether their stocks were also going down. Because it seems to me that while the national oil companies are coming up very fast, as you described quite eloquently, that this has created a huge opportunity for privately owned service companies that can support NOCs in a way that they can say they don't need international oil companies, but they do need Western services, which means they can get the technology and the advice without sharing equity or control. And just to add to that, I mean, where my question is driving to is, do you think that the new role in the end for international oil companies will be more to act as service companies for the big new super majors of the future, which you're talking about?
Well, it's certainly a question that we as a firm, and I know as an institute, spend a lot of time pondering. From our perspective as a capital market practitioner, I'm not certain that we see the future all that clearly in terms of any specific model, but rather really a variety of models. There is clearly, in our view, overcapacity among the international oil companies. I think all you need to do is sit through a series of board meetings to see that some of these extremely large projects that are being undertaken by these companies around the world, when looked at on an economic basis, are frankly marginal. And I think that in and of itself is a great indicator as to the fact that you have a tremendous overcapacity of capability to apply against the resources and the opportunities that exist. So therefore, this is an industry built upon consolidation, certainly on the IOC side as well as on the NOC side. I think the industrial logic is certainly present, the financial logic is present, and it's really the politics that will drive to what degree we see a changed landscape through consolidation. At the same time, I think, as you correctly point out, there are other models as well. We certainly think in terms of the cooperative models between NOCs and IOCs, whether it's upstream, downstream, swaps, joint ventures, other types of arrangements. Certainly we are having our fair share of those discussions, and I sense that while none have surfaced in a material form as yet, that we will see something along that line manifest in the very near future. I think that, again, when you think about the intersection of the IOCs relative to the NOCs, it all feels a bit inevitable that there will define new models in which they cooperate together that really combines the best of both. In essence, accelerates the IOCs in their current quest, which is begin to look more like NOCs, as well as accelerate the NOCs, which through their internationalization are trying to look more like the IOCs. I mean, I think it's easy to see how that line gets blurred and how facilitating transactions. As to whether they'll ultimately become service companies and give up on reserves, I think that really remains to be seen. There's such a long history there, and we could spend probably a session on that topic in and of itself. But certainly there is a very large and expanding role for oilfield service companies to take on these types of operations, and we've certainly seen that to a great extent. And while that share price graph didn't indicate that the service companies were leading the pack, so to speak, they have performed quite well, and I think we would expect them to continue, which again has the same effect of increasing the cost structure of the industry as well.
Tom, I have a question. You mentioned access to technology as part of your thesis for the emergence of the supranational. Claire spoke about, she mentioned technology in a rather monolithic way. As we know, the service companies have different skills. The IOCs pride themselves in their reservoir know-how and knowledge, and the capabilities of the service companies in that realm varies widely. Could you elaborate a little bit more on your views of this need for access to technology, where they're going to get it?
Well, first I should clarify, I think my point about technology was from the perspective of how the capital markets look at these individual companies, and they do make assessments based on what they view as their own technical capability. A company like Petrobras that has clearly demonstrated deep water technology is a very strong, definable skill set inherent in that company that, to the extent it begins and continues to internationalize, utilizing that skill set, that really provides a crux or a thread, if you will, for the markets to pick up on, to understand that those endeavors are likely to be successful. So I think really the point of putting technology on that slide was really more from the standpoint that as you think about the profile of what might be the next generation of oil company, there's no question that technology has to be a major defining skill associated with that entity. Now, as to whether that is, or how you break up that technology in terms of the types of skills, or the types of resources, the types of equipment, et cetera, is all part of the interesting evolution, which we hope to play an active role in, as I'm sure you do.
Putting together some of these comments, on the NOCs wanting to internationalise, the IOCs having a lot of capability they're not using, but a lot of that capability might be of interest to the NOCs, is one way we might see it, or something we might see in the future, of more NOCs taking over some of the IOCs?
Well, I would hate to make a bold prediction like that might end up on the front page of the paper. Look, I think anything is possible. I think it's easy for any of us to look out upon the existing constituency of the national oil companies, and we call them national oil companies, but again, many of them have public listings. Many of them have a lot of the requisite skills to do that type of transaction, to potentially facilitate that type of post-merger integration that's necessary. We've certainly seen, again, we've referenced the Unocal CNOC transaction a number of times yesterday and again this morning, I understand. But again, that is emblematic, I think, of the type of ambition, not just CNOC, but a number of companies have. And you can't help but be struck by the fact that when you look at a number of these national oil companies that do have public listings and you look at their scale, their ability to raise billions and billions of dollars of capital off their balance sheet at rates that are not that far off from what international oil companies can raise, it's a tremendous amount of firepower. The whole, of course, elephant in the room here is politics. And having worked for Unocal during the transaction, I can tell you that from my own perception, I mean, politics is something that's, I guess we'll know it when we see it, but it's very hard to plot a path through it in the current environment.
Do you see a couple of charts that you mentioned there in the first place? Is basically as a result of market expansions that value most on potential growth instead of value. The difference between the IOC share price and NOC share price. And second one is...
What's the question? Hold on one second. What he's asking is, when people value the NOCs, like after 2006, they start to go above the IOCs, is that people's perception of the future value of those companies, or have people just see fundamental performance in a sort of a quarter-to-quarter basis?
The difference between the perceptions of potential growth at the NOC versus the real value of the company itself. And second question is, what do you think about the effective collaborations between NOC and IOC that increase capital efficiency in terms of the energy supply?
Right. On the first question, I think you're referring to the chart that had the forward valuation associated with the price-earnings ratio, which was reflecting that the national oil companies were actually valued more highly than the international oil companies. And I think, again, as really implicit or perhaps somewhat stated explicitly in the prior comments, the international oil companies have such tremendous structural issues that they're confronting. If you think about the value of their legacy assets as those really begin to go into decline, and every incremental project, it goes beyond the point of whether they're replacing production or not. Are they replacing value? And of course, when these projects They don't have the legacy advantage of having the existing infrastructure in place, therefore the marginal economics. And all of this is getting incorporated in through the marketplace to essentially put a value on what a future dollar of earnings should be worth of an international oil company versus a national oil company, which has the resource base, which has the inherent advantage in terms of its ability to put in the infrastructure, potentially with help from the government, to derive the necessary economics. So what you're seeing in the context of those charts is the market's really making assessment about the future competitiveness or the future profitability, if you will, of tomorrow's dollar from an international oil company versus a national oil company.
Can I ask two questions? The chart sort of changed in 2006. So my question is, do you think the markets are reacting to things like Putin and Hugo Chavez and some of these sort of news-driven events, that the market's perception of whether the IOCs will get access in the future has changed? Perhaps in the past there was the sense that the NOCs would fail and then the IOCs would come back in, but now that perception is over. And then the second part of the question is, do you think, because you raised this interesting question about whether, or maybe somebody else raised this interesting question about whether NOCs might actually take over IOCs, did the CNOC attempt for Unocal raise investors' interest in owning an NOC share because they anticipate that might be the takeover party and want to be in that share?
Well, I think your first question was there something specific about the inflection, semi-inflection point in 2006? I'm not sure that there was, as much as it was a confluence of negative events on the IOCs. Part of it was reserve replacement as numbers come out and people realize that despite what were thought to be attractive numbers, that projects are delayed or there are cost issues or a confluence of factors that leads to disappointing results. And then you overlay that with the general politics of what's going on in the world, and people can come to a fairly pessimistic point of view. So I think you saw a lot of that manifesting, and you still see it manifesting today. Hugo Chavez is a perfect example in the heavy oil area. I think your other question was in relation to
is the market anticipating that NOCs might make an acquisition of these other IOC companies?
Well, I think that I don't know that the market is necessarily. I think you could in fact argue that the market is making the assumptions that they're not going to do it, because if the market was really making the assumption that the IOCs were vulnerable from a takeover, I think what you'd see is some amount of froth coming into their share price, if you will, to reflect the fact that they probably wouldn't be taken over with zero premium, and so therefore in anticipation of it. And in fact, if anything, that probably I think again it's an interesting world we're living in. We've obviously all witnessed the front page in terms of a lot of these leverage buyouts, very large, huge size, all the money that's being raised by private equity, whereas in the past people would say above a certain size of company you're virtually invulnerable to at least a financial a buyer with largely financial characteristics. And I think so you have that phenomena, you have the phenomena of very cheap money just in terms of rates, and the chart which again I perhaps didn't describe as well as I needed to, the chart which really showed how risk is being priced in the emerging markets is an incredibly important driver of a lot what's going on in the NOC valuation. I mean, essentially, another way of saying that is that if a country in an emerging market, say they wanted to borrow money in 2000, they might have to borrow money at U.S. Treasuries plus 8 or 9%. And basically what that chart shows is that over the time that people have repriced that, as people have wanted to make more money for their money, they've chased these markets and they said, well, maybe they're not as risky as I think they are. They've essentially bought those rates of return down on that money. So now that same country or company in the emerging market can raise the same amount of capital, potentially even a larger amount of capital at Treasuries plus 100 basis points. So basically saving 8 or 9%. And as we all know, those of us who have done project economics or acquisition economics, that's a very, very material change in the cost of money. And of course, people who do DCFs, who look at these companies and say, I think I can understand the future prospects of these companies in a financial setting, and I can discount those back to understand the value of that and what I'm willing to pay. If that discount rate is going down because of the perception that they're less risky, that an NOC is no more risky than an IOC, then by definition that's going to increase your value accordingly. So again, we could have a real snapback here as it relates to because I think we all recognize we live in a fairly unstable world. Bad things can happen, and that could change the whole perception of risk in capital flows, and to some extent could reverse a lot of what you've seen over the last few years. But there's a tremendous amount of global liquidity. It's hard to imagine it all just having the brakes slammed on, so to speak. So I think, generally speaking, we expect this trend to continue.
May I ask, what you couldn't tell from the charts, but what impact do you think integration or lack of it has on this, shall we say, increased valuation of NOCs? Because you have very few NOCs that are purely downstream, like Sinopec. You have even fewer NOCs that are international product sellers, like KPC. Do you think that the run-up in crude since late 2003 and the relatively uneven margins, which are coming down right now, are a contrast, part of the contrast between IOCs and NOCs? People are valuing them on their oil, not on their efficiencies.
Not necessarily. Again, I think when we speak about the super major era past, we obviously had lots of consolidations, Exxon, Mobil, we know all the names. Part of the issue in those transactions was always that you had restraint of trade issues, you had to sell some of the downstream assets, you were selling into a very weak market, which created a lot of friction, if you will, for those transactions. That's not necessarily the case today. In fact, because so much of what's driving the price is demand-driven as opposed to supply-driven. In fact, those portions of the value chain are actually can tend to be and have been quite highly valued. Now, clearly that's coming down in some measure. But again, I think this balance between upstream, downstream may well be part of the puzzle as to thinking about how the industry evolves, particularly if you believe that the IOCs in the larger, more mature markets have that market access. That really gives them something very special to offer up as part of a unique arrangement. So we'll see how it sorts out, but if nothing else, will be interesting times. Thank you for your... Yeah.
Okay, one last question. Then we have to let Tom go to the coffee break. Such an interesting talk.
Your presentation and that of Claire Laurie this morning actually, to me, stand uneasily with the views expressed severally yesterday that the United States does not have a real alternative to reliance on IOCs. Now, what do you think, in light of these issues you raised, since the IOCs are no longer replacing their reserves and are likely to lose market share, that the United States, for the sake of energy security, might find it necessary in the near future to consider forming an NOC? Well,
I am largely in the camp, I think, of the majority yesterday as it relates to I think the question's a U.S. NOC, that's fraught with all kinds of issues. But on the other hand, I'd be remiss as a practitioner in the mergers and acquisitions area to say that given the overcapacity in the international oil company, I mean, if you look and you see clearly that you have 3 IOCs in the U.S., you have 3 in Europe, where are we going to be 2 or 3 years from now, or 5 years from now? Are we going to still have 3 and 3, or are we going to have 2 and 2, or 1 and 1? And I think, again, you could argue that the industrial logic's there, you could argue that the financial logic's there. It's really probably the politics that's most difficult with thinking through those types of that level of industry restructuring. But it's back to that point in that chart that had the bars that showed really when you add up all the IOCs, what a small percentage of overall world reserves they have. I mean, if the U.S. population kind of the voting public, if you will, came to a point of view that it was in the best interest of the United States to have a very, very large NOC that had the kind of scale, that had the kind of resources, even well beyond any individual company we have today, that was good for our energy security, then it's very likely something like that would happen. And that's a question of, will the politics evolve in that direction or not? But if they do, then I think certainly the other underpinnings of that type of industry restructuring are certainly in place and to a large degree logical.
Well, what a provocative and interesting comment to send us out to the coffee break.
Thank you.